What are bonds? A bond is the most common type of fixed income security. It is a debt instrument that makes a series of fixed interest payments regularly and pays the principal amount on the maturity date. Entities such as governments and corporations issue bonds to finance various projects. At its core, a bond is just a loan that investors make to the bond's issuers. When the bond is first issued, its value is basically the amount being loaned, called the face value of the bond. In exchange for this loan, the investor gets a regular interest known as the coupon. Bonds are issued for a specified period. This duration can be a year, 3 years, 5 years, 30 years, or sometimes even more. When the bond matures, the issuer repays the loan to the investor. Let's look at the basic features of bonds. Both financial and non-financial companies issue bonds, called corporate bonds. Sovereign national governments issue bonds. The US Treasury bond is a good example. The non-sovereign governments also issue bonds, including entities other than the national governments, such as the state of California or the city of Toronto. Then there are quasi-government entities. These entities are not under direct obligation of a central bank or the national governments. For instance, the Federal National Mortgage Association or Fannie Mae. Supranational entities operate globally. The European Investment Bank, the International Monetary Fund, and the World Bank are some examples. The bond's maturity is the date when the principal needs to be repaid. When a bond is issued, the time remaining until its maturity is called term to maturity or tenure of a bond. A bond's maturity can range from 1 day to 30 years or more. Coca-Cola and Disney have issued bonds with original maturities of 100 years. Then there are bonds that do not have a maturity date. They're called perpetual bonds. They pay interest but don't carry any promises of repaying the principal amount. Bonds with maturities of 1 year or less are called money market securities, and those with more than 1 year are called capital market securities. The par value of a bond is a principal amount that is repaid to the investor at maturity. It is also known by other terms such as face value and redemption value. Par value is quoted as a percentage of par. For instance, a bond with a par value of $1,000 quoted at 98 will be selling for $980. If a bond is selling above its par value, it's trading at a premium, and when it's selling below par, it's trading at a discount. And of course, if its selling price is equal to par value, it's trading at par. The coupon on a bond is the annual percentage of its par value. Some bonds pay annual coupons while there are those that pay semi-annual, quarterly, or monthly interest payments. A $1,000 par value semi-annual pay bond with 5% coupon will pay 2.5% of $1,000, or $25 every 6 months. Please note that there are bonds whose coupon rate varies throughout their tenure. If a bond has a fixed coupon rate, it's called plain vanilla bond or conventional bond. There are special types of bonds that do not pay any coupon payment before maturity. These are called pure discount or zero coupon bonds. These bonds are sold at a discount to par value, hence the term pure discount. The interest accumulates till maturity, then it is repaid to the investor along with the par value. For instance, a 10-year $1,000 zero coupon bond with 7% yield would initially sell at around $500, and then it will pay $1,000 to the bondholder at maturity. As there are different currencies, so are the bonds denominated in those currencies. A dual currency bond makes coupon payments in one currency and repays the principal in another. And a currency option bond gives the investor or the bondholder a choice to choose a pair of currencies in which they would like to receive payments. Bonds are subject to different regulations and legal requirements, which depend on factors such as their place of issue and the place where they are traded at. A bond issued by a firm domiciled in a country, also traded in that country's currency, is called a domestic bond. If a firm incorporated in a foreign country issues a bond that trades on the national bond market of another country in that country's currency, is called a foreign bond. If a foreign firm issues bonds denominated in yuan that trade in China, are foreign bonds, and these are known as panda bonds. Similarly, if a firm is incorporated outside of the United States and issues a bond denominated in US dollar and trades in the United States, it's also a foreign bond and it's called a Yankee bond. Euro bonds are issued outside the jurisdiction of any one country and denominated in a currency different from the currency of the countries in which these are sold. Initially, Euro bonds were created to avoid US regulations. These bonds should not be confused with bonds denominated in Euro currency or domiciled in Europe, although they can be both. Probably it's a little confusing, but an example of a Eurobond would be a bond issued by a Chinese firm denominated in the Japanese yen and traded in markets outside of Japan. Global bonds are sold inside as well as outside the country in whose currency they are denominated. For example, a dollar global bond will trade in New York, which will be its domestic bond market, as well as in Tokyo, which will be its Eurobond market. Eurobonds are known by the currency they're denominated in. For instance, a Eurobond denominated in US dollar is called a Euro dollar bond. Similarly, a Euro yen bond is denominated in yen. Most Eurobonds are issued in bearer forms, which means that their ownership is evidenced simply by the possession of the bonds. In registered bonds, however, the ownership is recorded, hence bearer bonds are more popular among folks looking to avoid taxes. In the United States and Canada, the legal contract between the bond issuer and the investor or the bondholder is called a bond indenture, and elsewhere it's more popular by the term trust deed. It simply defines the restrictions and obligations on the bond issuer. It serves as the basis for future transactions. Other major issues that a trust deed contain are legal information about the issuer of bond, collateral or assets that are pledged to support the bond repayments, information on credit enhancement, and the covenants that describe the actions, if any, that the issuer must take or refrain from. There are many types of entities that issue bonds, and an investor must ensure that the issuing firm has actually made the promise on interest and principal repayment. Sovereign bonds are generally considered the safest since they are issued by the treasury of the issuing country. Corporate bonds are issued by big companies such as Microsoft and Coca-Cola. It could also be the subsidiary of the parent company or by a holding company that holds many companies. As an investor, you must know your bond issuer because the credit quality differs among bonds. Sometimes a company creates an entity for the sole reason that the new entity could own specific assets and issue bonds, which would generate funds to buy assets. In the United States, these are called special purpose entities and special purpose vehicles in Europe. And the bonds they issue are called securitized bonds. For example, a firm could sell the loans it has made to customers to a special purpose entity that issue bonds to buy those loans. Now, the interest and principal payment on these loans will be used to make the interest and principal payments on the bonds. Usually, the bonds issued by the special purpose vehicle are at a lower interest rate than the bonds issued by the original company. And the reason is that the assets that support the bonds are owned by special purpose vehicle, which are then used to make the payments to the holders of the securitized bonds, even if the company goes bankrupt. And this is the reason that SPVs are also known as bankruptcy remote vehicles. How do the issuers repay the bonds? The tax receipts of the issuing country are used to repay the sovereign bonds. while the bonds issued by non-sovereign government entities are repaid from different sources such as general taxes or revenues from projects such as an airport. Companies generally repay their corporate bonds from cash generated through the firm's operations. Collateral and credit enhancements. In unsecured bonds, the investor has a claim to the overall assets and cash flows of the bond issuer, while secured bonds are supported by the claim to specific assets of the company, and this factor reduces the default risk and yield of secured bonds. Just a quick note, if a bond carries more risk, the investors demand more yield as a compensation for the additional risk. Since secured bonds are backed by collateral, they are senior to unsecured bonds. While in unsecured bonds, two different bond issues might have different priorities in case there is liquidation or bankruptcy. In case of a claim, secured debt has the highest priority. After that, the senior unsecured debts, and then of the subordinated debt. Sometimes secured debt is known by the type of assets pledged as collateral. For example, equipment trust certificates are backed by actual equipment such as railroad engines and oil rigs, while collateral trust bonds are backed by financial assets including stocks and other bonds. Please note that the term debentures means unsecured debt in the United States and elsewhere. In Great Britain and some other countries, however, it refers to bonds that are collateralized by specific assets. The most common type of securitized bonds are the mortgage-backed securities, or MBS. The underlying assets here is the pool of mortgages. The interest and principal from mortgages is used to pay the interest and principal on mortgage-backed securities. Covered bonds are more popular in the European countries. These are issued by financial companies. The structure is similar to asset-backed securities, but the collateral remains on the balance sheet of the issuer. No special purpose vehicle is created in this case. In case of the firm's insolvency, these underlying assets are protected by special legislation. These assets are bankruptcy remote. As opposed to the special purpose vehicle, a covered bond also provides recourse, meaning that the issuer must replace or augment the non-performing assets to ensure that the money for interest and principal is always available. Credit enhancement of bonds can be internal, built in the structure of the bond, or external, where a third party provides the additional credit. One way of internal credit enhancement is through over-collateralization. Here, the pledged collateral has a value greater than the par value of the issued bonds. However, this method has a limitation. The additional collateral is itself the underlying asset, so when the defaults are high, the value of this excess collateral declines. Cash reserve fund and excess spread account are two other methods of internal credit enhancement. The cash reserve fund is simply a cash amount reserved to make up for credit losses on the pledged assets. In excess spread account, the promised yield on the bonds is lower than the promised yield on the assets, supporting the asset-backed security. This arrangement offers protection in case the yield on financial assets decreases. And when the assets perform according to anticipation, the excess cash flow can be used to repay the principal on some of the outstanding bonds. Another method for internal credit enhancement is to divide a bond issue into different tranches. Tranche is French for slice. Hence, the bond issue is sliced into different ranks. If the assets supporting the securitized bond perform poorly, these losses will be first absorbed by the bonds with the lowest rank, then the next ones with the higher rank, and so on. Which is why the senior-most tranches in such a structure have high credit ratings, because the loss has to be colossal enough to reach the senior-most level that it could not have been contained by the subordinated tranches. The junior tranches must offer higher yields to investors as a compensation for additional risk of default. This structure of tranches is also known as the waterfall structure because the available funds are first given to the senior-most tranche then to the next highest priority, and so on. In external credit enhancement, there are surety bonds issued by insurance companies and serve as a promise to make up for any shortfall in the cash available for required payments on debt. Bank guarantees are similar. A letter of credit is issued from financial institutions and serves as a promise to lend money to the issuer in case it doesn't have the funds to make the required payments on the covered debt. Bear in mind that these three external credit enhancements increase the credit quality of the bond and lower their yield. However, if the credit quality of the guarantor decreases, it also lowers the credit quality of the covered debt. Taxes on bond income. Most of the times, the interest income paid to bondholders gets the same tax treatment as ordinary income, and the tax rate is the same as of a salary. The interest income from bonds issued by the municipal governments in the United States are usually exempt from national income tax as well as state income tax in the state of issue. There's also the case if the bondholder sells the coupon bond before it matures. This sale might be at a gain or a loss, depending on its face value. These gains and losses are treated as capital gains income instead of ordinary taxable income. Capital gains are normally taxed at a lower rate compared to ordinary income. If a person sells an asset after owning it for more than a minimum amount of time, the capital gains it will generate might be treated as long-term capital gains, and the tax rate for which is even lower. Original issue discount bonds are sold at a significant discount to par. These bonds can generate a tax liability even if no cash interest payment has been made, because the gains on these bonds over their tenure as the price moves closer to par value is simply the interest income. There are several tax jurisdictions where a portion of the discount from par at issuance is treated as taxable interest income each year. Such a tax treatment allows for the tax basis of the original issue discount bond to increase every year by the same amount of interest income recognized. Hence, there is no additional capital gains tax liability when the bond matures. There's a symmetrical tax treatment for the bonds that are issued at a premium to par value in some jurisdictions, which allow a chunk of the premium to reduce the taxable portion of the coupon interest. If you want to buy government or corporate bonds, you can do that the way you buy shares through a broker. There are many bond finders on the internet. SAMT is a Swiss-registered wealth manager. We can help you manage your money with scientific concepts. Visit samt.ag to learn more.